No change expected. It all seems to be down to the statement and just what Jerome Powell tells the markets. Also awaiting jolts later on this afternoon. That is something else which we are talking about. Another economic data point to watch out for. We'll be watching the markets ahead of all that. Welcome to Beat the Street. Let's take a look at this breaking news we had in the last 15 minutes coming through from ADP, where we see the numbers coming through with a lower than expected print. We've got 113,000. I think anything between 130 and 150,000 was expected. Let's take a look at what's happened in terms of the move on the markets. This is the euro dollar. And I'm looking here at 5-minute candles. So every single candle here represents a move after that release. You can see we've got 4 candles here where we've seen just the tiniest of upticks in the euro against the US dollar. It doesn't really change anything, to be honest with you, for the Fed later on. Not that it was ever going to, because we have a Fed which is fairly transparent. We are fully expecting the Fed not to move on interest rates later on. We've got the JOLTS numbers out a little bit later on this afternoon, the job openings, where we're looking for a print slightly lower than we saw last month. The previous reading had been 9.6 million. We're looking for 9.25 million, around about that sort of figure. But what that means is it means that there are less jobs out there for people either wanting to move or get back into the workplace. Does it have a significance? Well, it certainly can do, but it depends on where the number comes in and if it's widely away from what economists had been looking for. But economists, generally speaking, are looking for the Fed to remain on hold this time around on the markets. Let me just quickly, on the interest rate picture, let me just quickly update you on what's happening as well on the IG platform, just to show you where we are in terms of the open. These are 24-hour markets here. We're trading pretty much where we closed out the 24-hour markets yesterday, not too far away from the cash close yesterday. We saw gains across Wall Street, not too much in terms of upside, but there was nonetheless an upside move. So the Dow not expected to move too much on from where we saw yesterday's close, and it's the same sort of price action we got. We really are just seeing traders sit on their hands at the moment, awaiting that news out later on this afternoon in about 5 hours time or so from the Federal Reserve with the decision on interest rates. This is the US Tech 100. Again, a little doji star candle for technical analysts. That means, of course, it means that these markets are awaiting news, are awaiting some sort of decision-making opportunity on these markets, and that's pretty much what's happening. And we're witnessing what have been relatively light volumes on the markets across Europe this morning. And there's not really much giving a steer today. We've got the Bank of England, of course, as well tomorrow to watch out for. But we're taking a look at these US markets and how things are standing as we go into the start of today's session. Now, let's catch up with more on this and some of what the interest rate decision is likely to deliver later on this evening, and collecting our thoughts together after those ADP payroll number and ahead of JOLTS. We're off now to Tasty Live and Chicago, and join us is Christopher Vecchio. Chris, welcome. Tell us a little bit more about your thoughts on where we are and how the markets are circling this interest rate decision from the Fed later on today. As I say, we still got JOLTS, the job opening number, to come through. And this ADP number, not quite as weak as we saw last month, but it's not as robust as people thought perhaps it might be. As I say, collecting your thoughts together, what's this telling us?
Well, the jobs market in the United States is clearly still moderating, although it's difficult to put too much faith into an ADP report, which last month tracked in at 89K, and the actual non-farm payrolls release came in north of 300. So while this is certainly still a soft figure, right around 110,000 jobs added, it doesn't necessarily reveal much of anything what the official jobs data will show us this coming Friday. But that doesn't really matter for the Federal Reserve at this point in time. The Fed, leading up to their communications blackout window, had been very clear in telling us that the moves in the bond market had gone far enough to at least substantiate the idea that they didn't need to raise rates anymore moving forward. I don't think the market is anticipating a move today. In fact, if you look at the CME FedWatch tool, there's less than a 5% chance of a hike or a cut currently priced into this market. And when you look out for the December and the January meetings, there's less than a 35% chance of an additional hike moving forward. Instead, it's going to be about Jerome Powell's tone, what he says at 2:30 p.m. Eastern, not the policy statement at 2 o'clock, but what he says at 2:30 p.m. Eastern time. And if the market feels comfortable enough saying, you know what, the Fed's done their job, we can start moving forward and begin thinking about what is around the corner. At least for this jobs report today, Jeremy, we see here that the markets are responding nicely. Bond yields are down across the curve now. Equity markets are up. Hopefully that sets us up for a better afternoon here in the States.
Something else I'm always being asked by clients, IG clients, to ask all guests is just what input the oil price is going to give to inflation. And you've got to look at the geopolitics, I guess, for this to work out perhaps possibly maybe where things go. A World Bank recently suggesting that if there is an uptick in geopolitical concern and the violence around the Middle East, we could see oil coming in at $150 a barrel. Now, that not quite double where we are, but it would be a severe uplift. And I guess any further uplift does present the central banks with a problem because oil is a big component part of inflation.
It is a big component part of inflation, but it's a component of the headline inflation number. The Federal Reserve, like the European Central Bank or the Bank of England, really cares about that core reading, which strips away food and energy. And that seems a little confusing for the average person because food and energy are such significant parts of our lives. But they're also very volatile components, and they're components of inflation that central banks really don't have any control over. It's not like Fed Chair Jerome Powell can pick up the phone and call up the various OPEC ministers and say, listen, we really need you to raise production. That's just not going to happen. And so when you take a look at what's happened with oil here recently, the fact is on a year-over-year basis, it's actually still down. It's not a positive contribution here. Oil would really have to take a significant leg up moving forward. And I'll be honest, I'm looking at these charts here recently. The fact that we haven't seen a more significant rally since the atrocities that occurred on October 7th tells me that this is a weak market. There may be some geopolitical premium in here right now, but it's not a market that wants to run higher, say the way that gold has. Oil prices, to me, are probably stuck trading sideways for the foreseeable future. There are meaningful growth concerns coming out of the U.S., out of China, out of Europe, and that's offset by what we've seen in terms of this horrible situation unfolding between Israel and Hamas.
Yeah, absolutely dreadful, tragic situation, as you say, for so many people. Just quickly going back to the commentary around where things are, what's happening. Volatility is down. We've got thin volumes across Europe. Obviously, we are awaiting that decision from the Fed later on today. In terms of the longer term picture, we've got ISM, of course, later on today as well in the US, where we're looking at a 49 print, which is below that sort of watershed 50 mark, and it technically means a contraction. We saw relatively robust GDP numbers, of course, when we were talking this time last week in the States. Is that expected to start to leak a little bit? Are we expecting lower prints for GDP as we go ahead? And is this going to be of concern to the Fed? Just returning to that Fed statement later on today, how much time will they spend talking about the outlook for growth?
I don't think the Fed is concerned if growth comes in a little bit because, quite frankly, that's exactly what they're trying to engineer. The whole goal of the Fed's interest rate tightening cycle is to reduce aggregate demand in the economy, to get consumers to stop spending so much money. Now, according to the data that we've seen thus far in the month of October, we're still probably tracking near a 2% year over year, at least a 2% annualized growth rate in the United States, which is good, not as hot as what we saw for the third quarter. But much of this is on the back of government spending. The United States is running a wartime-like deficit right now. We're expected to borrow around $1.5 trillion over the next 2 quarters, which will in turn help keep the economy afloat. But it can mean that you're going to see a greater supply of treasuries in the market, and that could mean prolonged higher interest rates moving forward. Those higher interest rates, they typically take 12 to 18 months to filter through into the broader economy. And knowing that the Fed's hike cycle started in March 2022, we're now actually in the teeth of when all these rate hikes are coming home to roost. So economic growth moving forward should slow down in the fourth quarter, in the first quarter, even if the government is spending a lot of money to offset that. Either way, though, this is exactly what the Fed wants. The Fed wants to see a weaker labor market. They want to see weaker growth. They are Phillips curve economic theorists at the end of the day.
And of course, the elevated bond yields are actually doing some of the heavy lifting for the central banks anyway.
That is what the Fed tells us. We heard this very consistently from the various regional Fed presidents in early October into the middle of the month. They think that the 50 basis point move that you see in the 10s and the 30s does reflect this increasing term premium, but that in turn is a result of the market saying, listen, we're not really sure if the Fed is going to be able to cut rates down the line. And so rates have gone up across the curve. That does mean tighter policy. The market is leading the Fed, as it were, and that is often the case. And so now the Fed can sit on their hands. Enough is enough. Sure enough, when you look to Fed funds futures or the SR3 contract differentials, you see that the market does not believe that another hike is coming.
Yep. Okay, Chris, we'll leave it there. Thanks indeed for joining us. That's Christopher Vecchio, chartered financial analyst for Tasty Live, joining us there from Chicago ahead of the Fed interest rate decision a little bit later on. As Chris was saying, it's really all about that statement and the general feel for things as to whether or not we're going to get any moves in the markets after the decision later on today. There will still be 2 hours of trade on the US equity markets, so there's a lot of opportunity to trade these markets should there be an outlying statement that comes through on that word from Jerome Powell and the committee. Let's shift gears and take a look at some of the stocks to watch now. Just one stock I think I really wanted to pick up on as we go into the start of today's trade. AMD, Advanced Micro Devices, reported third quarter earnings on Tuesday, late on the trading day. In fact, after the close of markets last night, it beat analysts' expectations. The chip maker issuing a weaker than expected forecast. That was the downside. Let's take a look at the figures. Earnings per share, 70 cents. We'd been looking for 68 cents. And we saw a slightly heavier revenue number coming through at 5.8 billion. We've been looking for 5.7 billion. But I think after the markets last night, the stock did then start to gyrate because the fourth quarter was expected not to be quite so rosy as some had been hoping for. Let's take a look at the AMD share price. It is actually up 0.4% at the moment on the IG platform. And it is actually at the top of today's candle. This is the candle we saw yesterday where we saw the earnings come out. And you can see it was a lot higher than it was at the close. But that being said, it was also lower as well when that fourth quarter statement came through. But at the moment, I think I'm looking potentially for a rise around about 2% at the start of today's trade. We saw a 1.4% gain late in the session yesterday. Add to that the 1/3 of 1% rise at the moment, pretty much the top of the candle. So looking for a slightly stronger start for AMD when the company gets underway a little bit later on. This is a company which does have more involvement in the market that NVIDIA is taking part in these AI chips, more so than Intel. So I think anything, that's the part of the business that we should be looking at. Now, let's take a look as well at AIG, a company due to report after the bell this evening. AIG's third quarter earnings per share looking for $1.55 on revenues of 12.6 billion, suggesting a rise of 11.4% year on year. Now, this is one of the world's largest insurance companies, and basically it's trading higher on the news that insurance rates are hardening. Let's take a look at the very long-term chart. Now, that big steep drop we saw there was the great financial crisis, and it really hasn't moved much up, relatively speaking, from then. But let me just quickly run through and take a look at where we are. Get rid of that first of all if I can. Doesn't look like I can, but anyway, let's take a look at where we are in terms of the recent trade. And the big question is if we get a robust number coming through, will it rise to the recent highs back in April 2022 of $65.70? If it doesn't go up, could it go down? We've got a line of support kicking in at 57.02. We're trading, or will trade at the open today at 61.30. This company trades through and to the end of the session today, and then we get the earnings after that. So AIG, certainly a stock to watch as we go into the late session trade. Let's take a look as well at what we've got in terms of some of the other areas of the market. Just wanted to take a real hard look at what's happening with oil because production rose, according to the EIA yesterday, to just over 13 million barrels per day, up 0.7% on the previous month, beating the previous monthly high on November 2019. There's all this extra oil in the market. Did see a drop yesterday. Let's take a look at what the numbers came through at as of yesterday's API numbers. Crude oil stocks rising by 1.3 million barrels last week. And as a result of that, as Chris was saying earlier, we have been looking for US crude, and it dipped below yesterday's trade. If you can look at what's happening, yesterday, intraday, we saw the lowest print on these markets, I think in around about 6 or 7 weeks, down at the end of August this year. We have got a little bit of an uptick in today's session, but broadly speaking, I think technically with this piercing of this line of support at the 76.4% retracement on this fib, I'm more inclined to take a short position down to 77.56 rather than long. That being said, this is a retracement on what is otherwise a long market, so I wouldn't put money on it today, but as soon as you see another turn down and a lower close, that's your price target, 77.56. Just staying on the commodity charts, Chris also mentioned the price of gold in the context of the geopolitics and this rise up past 2,000. This is, again, just a retracement in what is otherwise an upward market for gold. Just awaiting for more news, more reasons to get into gold as a safe haven. That's it. I'll be back at 4 o'clock this afternoon with a look ahead to Thursday's trade. And one of the highlights of Thursday's session tomorrow will be Apple's shares trading after the market closes for its latest quarterly earnings report. Before then, it's the Bank of England. But so far as US markets are concerned, looking potentially for a slightly stronger start when trade gets underway at the bottom of the next hour, 45 minutes time. I'll be back at 4 o'clock.